Alright guys, today we're going to talk about how to forecast what your taxes are going to be like. As an individual, you know that if you have a job, you have taxes come out of your check, and at around April, or before that hopefully, you file your taxes, and if you have paid enough taxes, you might get money back, and if you haven't paid enough taxes already, then you got to pay more, right? And that's the same thing with corporate taxes. They have to kind of predict where their taxes will be or how much they're going to make. And then based on those numbers, they then start paying quarterly at least. They pay taxes toward the IRS. And then at the end of their period, they look and they go, okay, did we pay enough? If not, they got to pay in. If they did, they can apply that to next year or some other options. So what we're going to do is we're just going to go ahead and look at that process. So let's look at step one. Step one is forecast your sales. So that's kind of like how an individual would kind of predict what their salary is or how much money they're going to make in a year, right? And so that's what a corporation has to do, is they have to figure out how much money we're going to make this year. And so this right here is a forecasted income sheet that's finished. We're actually going to fill it out together in a video either tomorrow or after the weekend, depending on when this video is made. But I'm going to just kind of go over the basics of what's going on here. What I've done is I have taken net sales for 2015 through 2019 and put them next to each other. And then I said, okay, what am I expected to have in 2020? So the way I did this was I calculated the growth percentage between each year. So between 15 and 16, I had 5.12% growth. And then 16 to 17, I had 4.33, then 7.10, and then 1.10. Now once we got those four values, we then said, okay, what's the average growth for these 4 years, or these 5 years really? And that was 4.41%. And so we said, okay, if we grow 4.41% from 2019, we will be at 768,000 in 2020. So this is just a prediction model based on growth, you know, like looking at a line and saying, okay, where's the, you know, what's our prediction for where this line will be in 2020? And so that's that. And so that's where we start. Okay. Now there might be some other unknowns that we need to consider besides just using math, like you know, maybe our product is going to improve this year. We think it's going to sell more based on some information we have. So those are kind of things that might be adjusted, but for the most part, that's kind of how sales are forecasted. Okay, you take your past and then add in what you know. Okay, so once we know what the sales are going to be, then we start filling out the income statement for the future. And so that's what I've done on that other sheet. Is once we had sales, we kind of used predictions to figure out, okay, what will operating costs be, and we used some predictions in other areas to figure out what our income sheet will look like for 2020. Here's the income sheet. It's been filled out. There's a lot of things that there's a lot more thought that goes into this than what we're going to put into it, because for example, dividends do not need to be calculated because it's something that you'll know. You choose your dividends. That's doesn't have to be predicted. You will know what your dividends are. Depreciation can be predicted based on what you own without having to use this model. Amortization should be known. So these are the kind of things that honestly should already be known, but for practice reasons, we are going to use this prediction model using math. Okay, anyway, a lot of thought goes into it, is all I'm trying to say. And step two, we have an income statement. So now that we have that, there might be some things that we know we need. Maybe we want to make more product this year to ramp up production. Maybe we need to buy a shipping facility so we can get our products out to our customers faster. These are all things that maybe we decide we need to do. Well, if we keep everything the same, we won't be able to buy a shipping facility. So what we have to do is we have to decide, okay, how are we going to raise money? Are we going to offer stock or bonds, or are we going to get a loan? And once we've made that decision, then we have to go back to the income sheet and we have to make changes. So maybe if we got a loan, we'd have to increase our amortization and interest. If we got a bond, we'd have to just increase the interest. If we had common stock, that might change our dividends depending on what our plan is. And so point is, if we need to raise money, that changes the statement. So we make adjustments. But once we all agree, the executive team, the board of directors, everybody agrees this is it. We agree this is probably where we'll be for 2020. Then we calculate the quarterly payments. Okay, this is how much money we're going to have. This is what we expect to be our taxes. We're going to pay a quarter of that every 3 months. And so we're going to take a look at that part of it in a few more days after this to look at a corporate tax sheet, what that looks like, and how they calculate that, how do they account for it in their books, things like that. So that's it, though. Step 1 through 4. If you guys have any questions about this process, just email me or talk to me if you're in class, and we'll get those issues cleared up. But if there's nothing else, then I'll see you next time.